operating income mainly includes income from sale, lease rentals, export incentives, and miscellaneous income. In the current quarter, the increase is mainly on account of higher lease rentals for leasing out of property in the Adugodi premises and incentive received from the government of Maharashtra under the mega project scheme. The material cost as a percentage of total revenue from operations is at 66.8% in July to September 23 as compared to 64.9% in July-September 2022. However, the material cost as a percentage of net sales, that is excluding income from services and other operating income, is at 70.1% in July-September 2023 as compared to 67.3% in July-September 2022. The increase is mainly on account of mix impact, the higher share of traded goods, adverse forex impact on imported material, and the previous year had certain one-time credits, that is provisions written back which were no longer required. Employee cost for July to September 2023 is 3,355 million INR as compared to 2,751 million INR in July to September 2022. Increase is mainly on account of year-on-year salary increases. Also, previous year had certain one-time credits. Other expenses stood at 5,449 million INR, 13.2% of total revenue in July to September 2023 as compared to 5,781 million INR, 15.8% of total revenue in July to September 2022. The current quarter expenditure has decreased mainly on account of the following: lower spending on new businesses on account of sale of Project House Mobility Solutions business, lower one-time technical access fee in current quarter for localization of ECUs and common rail injectors. Depreciation for the current quarter is at 1,013 million INR, 2.5% of the revenue, as compared to 919 million INR, which was 2.5% of the total revenue in July to September 2022. Increase in depreciation in current quarter is on account of additions during the year, mainly in buildings and plant and machinery. Operating profit. With this, the operating profit stood at 3,900 million INR in July-September 2023 as compared to 3,392 million INR in July-September 2022. Which is an increase of 15%. Other income primarily comprises of interest on fixed deposits, intercompany loans, change in market value of mutual funds. The other income has increased from 1497 million INR in July-September 2022 to 1542 million INR in July-September 2023, mainly on account of increase in interest income. PBT and PAT. For the quarter ending July-September 23, your company posted a profit before tax, before exceptional item of 5,320 million INR as compared to 4,870 million INR in July-September 2022. As a percentage of total sales from operations, the profit before tax, before exceptional items, stood at 12.9% of total revenue in the current quarter. Profit before tax after exceptional items stood at 13,170 million INR in July-September 23 as compared to 4,870 million INR in July-September 22. As a percentage of total revenue from operations, profit before tax after exceptional item stood at 31.9% of total revenue in the current quarter. Profit after tax for the quarter ended September 23 stood at 9,989 million INR, which is 24.2% of total revenue from operations. Profit after tax in July-September 22 was 3,724 million INR, which is 10.2% of total revenue from operations. The profit after tax for the current quarter includes gain on sale of our Project House Mobility Solutions business, amounting to 6,054 million INR net of tax. On the technology front, next slide please. On the technology front, this quarter we commenced on-road trials following the development of our hydrogen ICE engine project, and post receiving permissions from the Ministry of Road Transport and Highways. Engine calibration activities to meet the BS6 Stage 2 norms have begun. Trials are primarily taking place on Bangalore roads and TAL, which is the Hosur Road airstrip. We will keep you updated on any new developments on this topic. Next slide please. We also wanted to give you an update on the work Bosch Limited has been doing around CSR. Since April 2023, a total of 8,000 plus volunteer hours were completed, involving 900 volunteers, of which 650 are from Bosch and 250 were from non-Bosch volunteers. For the second quarter alone, we have achieved 2,750 plus hours comprising of over 40 activities. The activities included tree plantation, lake rejuvenation, animal welfare, World Youth Skill Day, environmental projects, mentoring programs, school painting, medical facility enhancement and assistance, and so on. By December 23, we will cross 100 plus activities across all locations. The Bosch leadership team also took part in many of these activities. Next slide, please. Thank you all for your contribution and for listening patiently through the call. We will now address your queries. Thanks again and open for your questions.
Thank you, sir. We shall now begin the question and answer session. Ladies and gentlemen, at present we are all in the listen-only mode. For participants who wish to ask a question, I request you to please raise your virtual hand. I shall be able to see your raised virtual hand and will invite you in turn. Alternatively, participants can also type in their questions in the chat box. Please address your questions to all participants. The first question is from Pramod Kumar. Please unmute your line and ask your question.
Update on the electric vehicle business in India, especially on the two-wheeler side, where we are seeing the market has kind of bounced back pretty well after the subsidy cut, and we are seeing more product introduction by OEMs and everyone's talking about ramping up volumes. So if you can just share any update there in terms of how we are doing in terms of the category market share on electrification and how does it compare versus our ICE portfolio. If you can just help us understand that first, sir.
My MD Sandeep will take this up.
On the electrification front, I think your observation is right that post subsidy adjustments and changes, the two-wheeler demand has kind of recovered. On the passenger cars, we see a consistent demand of the EV cars. So we will continue to focus on our portfolio engagement in both these segments, and we will watch how the market goes before we can get into more specifics on portfolio enlargement.
Pramod, are you in line? I think he has dropped out, I think. Next question is from Gokul Makeshwari. Please, I have unmute and ask your questions.
Gross margins, well, you mentioned the fact that there has been deterioration on account of inferior mix but we've had a fairly benign cost environment with respect to the commodity prices, and we are primarily trading, which traded percentage has gone up dramatically over the last 2 years. So, not for the shorter term, but more, where do you see the margins coming back in terms of your localization program and trying to improve your gross margin profile? Because it's like nearly 10 percentage point lower than your longer term averages. So if you can just give a sort of a path in terms of how do we recoup our prior gross margins?
Yeah. Okay, Karin speaking. Yes, the gross margin, as already mentioned by my colleague Guru, we see currently, and as you already rightly mentioned, an increase in the share of the traded goods. This is partially coming out of the what we see, the change in the content of the vehicles, especially also in the heavy commercial vehicles. This is the exhaust gas treatment. Good news, in the heavy commercial vehicles, we have last year localized the injector. We are going currently ahead with the child part of this injector as a very important step. And in the future, we are currently also planning or making the further steps in the direction of the exhaust gas treatment. We have another effect which we see, and this is a change from the conventional combustion engine to the common rail combustion engine. There we have a general higher share in the material of the total costs in the common rail systems. This is based on the technology, let's say, so a lower value add share. And also in the common rail, we have picked up already from below the 50% now. This year we will end up at about 68% localization of the components, and we will go ahead to come up to a decent localization share also in the common rail systems. Of course, all these activities will support our gross margin in the future, and this is one of the priority topics, is localization of finished goods, localization of child parts, and localization of components here in India.
Thank you for that. So should I assume that the gross margin improvements is given that the localization benefits are coming sooner, the improvements in the gross margin should be reflective in more in the next forthcoming quarters rather than forthcoming years, given that we've already made some progress over here?
Yeah, so this is for sure, when we talk about localization, then this is not in the next quarters. So we are going ahead, but doing a localization with all the quality releases, with all the cross checks, with the customers' releases, etc. And this is also quite complex technologies, especially in the common rail and also in the exhaust gas treatment. So we are talking about a midterm.
Okay. Would you be able to quantify the capex budget for FY24 and 25?
For the current for the next year, we are estimating a capex of 3.5 billion, and for the year 25, we are currently in the middle of the midterm planning.
Okay, right. Thank you.
Thank you, Gokul. Next, Mr. Dinesh, you can unmute and ask your question.
The question is on the localization itself. So you talked about localizing EGT components as well. So that will be done through Bosch entity, or it will be done at the vendor's level? And what I'm trying to understand is, would that lead to lower share of traded goods, or particularly on the EGT side?
Yes. The answer to both is yes.
Okay, so Bosch should be localizing the EGT components. Got it. And secondly, you alluded to the fact that they've already reached 68% localization for common rail components. This we are looking to take it to up to 100%, or certain components will still be imported?
100% we will not reach. We even have in the conventional, and please do not underestimate a localization, even in our lovely A pump, which is for decades already here in India, we are at 95%. So the 100% we will not reach, but we will try to do everything to localize as much as possible here in India. But certain things, also volume-wise, make sense to import.
Sure, that's highly appreciated. And in this quarter, we saw almost 19% growth for our two-wheeler segment business. If I look at the underlying industry, production grew production in fact declined sub 2%. So what led to such a strong growth for Bosch in a weaker industry growth?
Well, this is Sandeep speaking. I think out of the total growth or degrowth of the two-wheeler segment, we need to segment the different categories. There is a higher distress in the commuter segment where our play is rather low, but in the premium part of the two-wheelers, the market has done better, and so that explains the reason why there is a disconnect between our growth and the industry growth numbers.
Got it. I have a few more questions, but I'll fall back in queue. Thanks.
Thanks, Dinesh. Pramod Kumar has again joined. Pramod Kumar, you can unmute and ask your question.
Opportunity again. And can you please provide us an update on the PLI scheme? If there's any progress which is being achieved there, and if yes, what kind of components are we getting the approval from the government, and when can we expect the benefits of the same kind of kicking in? And as it normally happens with such programs or such benefits, will you be also sharing some of these benefits with your customers, or would you expect the benefits to be largely retained at the Bosch end? So if you can just help us understand the PLI bit more in detail, that would be really helpful.
Yeah, so I'll not get into every specific part of your question, but I'll give you a general answer on PLI. Yes, we've applied and qualified for PLI. There's a lot of echo. Could you please mute?
Sorry, I'll unmute myself, but the problem is I can't unmute again if I have a follow-up, so I'll request
you can stay online, then it's okay. Yeah, let's continue. So, in general, we've qualified for PLI at Bosch Limited. We are planning to bring in lots of local manufacturing thanks to the PLI benefit that occurs as a consequence. We will, of course, as quarters go by, we will keep you updated on what has been the benefit of this, which product categories, which segments, and how this is going to be dealt with. In general, we intend to keep the benefits with us and also share where required with the customers, but this is not totally finalized as of now, and we will update you as we move forward.
Thanks, Pramod Kumar. Next, we'll go to the next to Pramod. Pramod Amte, you can unmute and ask your question.
So the first question is with regard to the royalty which you said you have paid lesser for ECU and the injector localization. Can you specify identity in the other expenses?
Royalty. The question is on royalty.
You have called out that in the slide, saying that your other expenses are lower because of some localization program on the ECU and injectors.
Okay, so you are referring to the P&L, to the other expenses, yeah?
Exactly, yeah.
Okay, got it. So we have different effects in the other expenses. One effect is we have a sales of business of the mobility platform, and therefore we have reduction in the spending for this project, let's say. This is which we see now in this quarter. Then we had in this quarter the reduction in the one-time cost of technical access fees. This is, let's say, depending on localization, depending on the product mix we have these technical fees. But this is, if we compare it to the last quarter, we see here a reduction. Then we had, we have a real cost-saving measures. That means this is a performance program. Also, we have that we are looking frequently in our cost, in our cost categories, and we are also making here real cost progress. And the fourth is that we also see a reduction due to better fixed cost absorption. If we compare it to the past, that we under proportional grow in our variable costs. If we are looking, or in our fixed costs, under proportional to the growth in our revenues.
Sure, thanks. And the second question is with regard to sale of business. What implication it will have on your sales and EBITDA because of this sale of business?
This has been explained in the past on what was the rationale and why we sold it. You want to comment on the one-time effect that has come in?
Yes. But perhaps we have to explain first the top and the bottom line. So this was actually in the last 2 to 3 years where we explored the mobility platform here in India, and we made investments via the other expenses into these platforms. Do we now see a huge effect in the top line, means in the revenues? No, we're selling the business. In the bottom line, we see it in this quarter under the one-time expense or exceptional items, where we see the sale of the business below the profit before tax.
So that's the Hinduja entity which you sold, right? The energy.
That's the Project House Mobility Solutions business.
Okay, sure. Thanks and all the best.
Thank you.
Thanks, Pramod. Pramod Kumar, I have unmuted your line again.
Yeah, thanks a lot for the opportunity. Again, I'll follow up on the commercial vehicle side, sir, because we're getting different views here. Some of the larger peers on the component supply chain side have started to call out a peak for the industry now, and some of the OEMs have also started to talk about the flattish trend emerging from 4Q. So in that context, given that you have exposure to all of them and across all listed, unlisted, and across tonnage, what are your thoughts on the commercial vehicle space as we go forward from here?
I think on the commercial vehicle, there was this peak which we saw the industry getting to in 2018. And then subsequently we have had a continuous downturn due to several factors which have been explained in the earlier discussions as well. But now we see a turnaround, albeit in a very low base. It is a slow recovery, and we have to basically keep a watch on the effect on larger investments which will happen in the infrastructure space. So we'll keep a close watch on this industry. Yes, you're indeed right that our exposure to this industry is very sensitive and high. So we'll keep a very close watch on it. So at the moment we see a slow but sustained recovery.
It's good to understand that there are some structural changes in the logistics sector in terms of how India moves goods. And as a consequence, for example, there's now FASTag, there are better roads, better infrastructure, and of course, a good amount of cargo is now moved on railways. But at the same time, there are higher tonnage trucks playing on Indian roads, unlike in the past. So there are many changes that are happening all at once. And my colleague already explained that we'll keep a very close watch on how the market develops over the coming years. Our own content per vehicle in this category is also increasing. So we have to bring in multiple factors in, and we will see how the market develops going forward.
Thanks, Pramod. Next is Mr. Viraj. Please unmute and ask your question. Yeah.
I just got three specific queries. First is on the contribution margin. So if I compare sequentially, right, the share of traded goods was, say, somewhere around 67%, is now close to around 65%. And if I look at the environment which we are in terms of the raw material, it's one of the most benign environment. And so I'm still not able to understand the mix part, or is it that other than the mix, in the past we used to be quite strong in terms of the contracts, in terms of the RM recovery or FX cost recovery. So is it that post BS6, the terms of the trade are no longer that strong, as what it used to be in a pre-BS6 environment? Just trying to understand, on the contribution part. So that is one. Second is on the capex. So at the AGM also we talked about upwards of 200 to 600 crores kind of a capex, and that was including PLI. But if I look at the first half, we've just done a capex of say 105 crores. So how should we understand the capex, if I have to understand in the sense of the localization which we are trying to achieve? So if I have to look at next, say, 3 or 4 years, what is the quantum of capex we would have to do to achieve those kind of capex, those kind of localization?
Would you like to start with the recovery?
Sandeep speaking. I'll just pick up the first question of yours with regards to the how do you say that?
Contribution margin.
Yeah, on the contribution margin and the recovery of economics. I don't think that there is, on a contractual basis, a difference between a pre-BS6 or a post-BS6. So we do have coverage for raw material recovery, indexing, etc. But what we have seen the last 12 to 18 months is a rather disproportionate increases in the cost driven by logistics costs, wages costs, energy costs, semiconductor related costs. So that is putting a lot of distress on the cost part of it, while we are also discussing with customers regarding this additional recovery. So I don't see it as a contractual issue, but rather a disproportionate circumstances we are passing through.
Just a follow-up, what is the extent of that additional cost which is still yet to be recovered? I mean, the reason why I'm asking is, if I look at the end OE space, you talk about CV, passenger vehicles, two-wheelers. Across the board, these are reporting one of the best contribution margins, and the commentary is on an improving trajectory. But when I look at a player like us, who offer a very strong technology-oriented product, the same is not get reflected in terms of the recovery part.
I think the extent of exposure, of course, depends on category to category, domain to domain. So there is really no one number which represents that. Of course, you are right that if we consider a vehicle manufacturer, possibly he has a lot more avenues and ways and means of recovering cost impacts from the market compared to a tier 1 supplier like us. So that's a continuous challenge. So we will be faced with this also the coming quarters, and then we will see how to navigate our position in the market.
On capex?
Yes, then I would go for the capex, and the capex which is planned for the year 24. I think you were referring to the next year to look a little bit into the future, which we are at 3.6 billion. This is mainly in the in our plants. And this is really, if we look into the localization, this is supporting our further localization strategy. If we go into the common rail, into the exhaust gas treatment, this is where we now set up the plants for the future. So more or less, we have partially, of course, we have to partially invest also further in our buildings, but the main part will go into the machinery in all of our production plants.
So the question was to achieve, say, the localization of, over a period of time, 90-95%. What kind of a capex that would entail? Just trying to understand the intensity in terms of spend it will require.
So to reach a 90-95%, this is really midterm, and therefore we cannot give you now here the guiding figure for this. What we are looking is into the midterm planning, and this is our planning how we would like to go ahead with the localization. But which figure I can give you today or for the next year, what we have planned and agreed to invest in capex.
And any thoughts on the surplus cash? Post this sale of business, it will just add to the overall cash balance, and the capex figure which you're talking about, even after that, the cash accrue on the balance sheet, it will just keep on building up further. So any thoughts on the surplus cash? What do we want to do with it?
Yeah. So as you rightly said, we have a quite good liquidity position, and what we are ongoing looking at is, of course, besides the organic growth and the investment we make into the organic growth, we also look strategically now in the midterm planning into an inorganic growth. Nevertheless, we have also to see that we have a transfer in the technology currently, plus to have a look how is the market moving in the direction of electrification and hydrogen. So therefore, we observe the market. We know that we have a very good cash position. Be assured that we would like to place the right thing in the market for the company.
So just to reassure you that there is a lot of internal focus on better utilization of cash and putting that to more productive use. We are looking into that seriously. As and when we finalize the plans, we'll get back to you.
Okay. Thank you and good luck.
Thanks, Viraj. Next is Mr. Sendil. Please unmute and ask your question.
Hi sir, good evening. Just one question. Recently in the EICMA 2023, Bosch has showcased a lot of recent innovations or products on the two-wheeler side, like integrated powertrain, radars, and stability control devices. So, what could be the relevance of those products with respect to Indian market, and what's the potential over the medium term? So that's my question. Thanks.
I think part of the technology what we showcased in EICMA, we are investigating the use case relevance into India as well. So there are certain topics on powertrain, certain topics on electrification, and also on the display units, which would be of relevance to India, and we'll follow them up with demonstrators, proof of concepts, etc. for India. Not all what we showed in EICMA would have direct use case relevance, but we are checking which of those would bring value and also create traction in the market. We'll keep you informed about it.
So typically there is a lag between what's seen at EICMA to what gets into the markets in India, even in premium bikes. So expect that delay, typically 3 years in most cases, and only some relevant technologies, and also sometimes they're even further localized for the needs of the Indian market and then brought in. So that work is on. We are talking to Indian OEMs about this.
Thanks, Enzo. Next is Mr. Ravi Purohit. Please unmute and ask your question. Yeah, we could hear you. Ask the request.
Okay, thank you. Yeah, sir, going back to the question on margins, I think a couple of years back we had shared more than 20-25% of our workforce, right? We have taken various cost initiatives, and yet after the end of the 2-year period, right after all those cost initiatives and everything else, the RM costs have also come off, logistic costs have also come off. If we had not taken those steps, our margins would probably be like low single digits today on the operating level, which has never happened in our history in Bosch. It's very confounding to investors whether is there a problem in our own is there a problem with our strength with our competitors, with our OEMs, and which has reduced over a period of time, or whether we have to pay more to the parent or the associate companies from whom we are importing more on transfer pricing. Because somewhere there is a lot of margin that has got lost during this period, and we can't seem to kind of understand. And the last 2-3 years we've also not been able to communicate as to what is the normalized margin that investors or should hope to, even on a medium term basis, right? Each time we have on these calls discussions.
Okay, I take it up and then perhaps you can add. I think these initiatives on the personal cost side were the absolute right ones. And if you look today at our position, we are in the current quarter in the personal cost at 8.1% of the revenues, which is a quite healthy number. If you look at the other expenses, with the cost contribution we made and together now also with the selling of the new business, we are back at about 13.2% of the revenues, which is also back on a healthy. So if we are looking at the P&L and if we are looking at the revenues, we see one thing, and these are the material costs. Knowing that we are coming from BS4 to a BS6 now, and yes, we have increased our portion of imported goods, of traded goods, which we are on the midterm now coming into the next localization wave, let's say. This is what I explained beforehand in the common rail, where we have to come up to a decent percentage of localization. And in addition, it is especially in the exhaust gas treatment where we have planned already which products we would like to localize here in India, and we are now going ahead to make these plannings on the midterm basis.
I just want to give a general perspective that every time there is a technology transition, be it from BS3 to 4, from BS4 to 6 now, or another technology standard coming in, there is a dip in the localization effort, and then over a period of time when the technology is maturing, we increase our localization extent and then reach a very healthy localization content. This is something that's been the practice even in the past, and that's the same trend that's happening today. There are now increased efforts to get higher levels of localization done at a faster pace. That action is already ongoing. But some of the other effects you see today, which are rather new, are the increases in material costs, increases in many other factors that have come in, which to a large extent will need to be passed back to the OEMs and then recovered, and that action is also on. So overall, I think we should be back on a healthy path soon.
Yeah, so if I could just extend that further, when we say healthy path and when we say medium term, are we talking of going back to our erstwhile range of margins? Is that something that we should work with? Because we used to make 18% margins EBITDA level in the past. We used to make 45% gross margins in the past. We are at 33% right now. So there is a huge gap between then and now. So when we say over a medium term we are working, can you assure investors or at least give some path to investors to say that, this 33 will go back to the historic band, or it's not going to happen, which effectively would mean that there is something structural that has come down in our business or in the overall operations?
We don't want to give you an outlook for the future like this. We are working. All I can reassure you is we are seriously working on multiple elements, and you will start to see the improvements over the coming months.
Okay. So over the last 1.5 years, we'd also mentioned a focus on exports, right? Growing our exports. We had mentioned them in our annual report. We had mentioned them at various platforms in the last 1.5 years. And we had said that we had fairly large ambition on export, right? Taking the export as a percentage of total revenue to mid-teens. So far, we've not seen much happening on that. Can you kind of share some insight into what is happening on the export side? Is it really a sizable opportunity? Is there any serious thing that is happening at the company level on export side?
So if you look at the current situation of the exports, and if you look at the global economical situation, and as Guru mentioned beforehand, we see the weak European market, we see a weak US market. We know that China is struggling with the growth rates, and I would say we are in a sweeter spot here in India, and this is what we also see. We see negative growth in all these areas, especially in the Eastern Europe. We see Germany very, very slow. So therefore, we also see, even if in our current low share of exports, we saw in this quarter a negative trend in the injectors for the passenger cars, which we usually deliver to Europe. We saw a negative trend. So therefore, is export a chance? And I would say, in generally, yes. But as long as all other markets are fighting like hell, what they currently do, this is, of course, then not the big chance for us to deliver in any way weak markets with overcapacities.
Okay. And Karen, just to clarify, when you mentioned midterm planning, when we say midterm, are we talking of 1 or 2 years, or are we talking about like more than 4 to 5 years?
Oh, we are talking to 4 to 5 years.
Okay. Thank you.
Thanks, Ravi Purohit. Next is Mr. Priyaranjan. Priyaranjan, you can unmute and ask your question. Priyaranjan? Yeah.
Yeah, so in terms of technology roadmap, I think the MD has showcased in one of the slides that the hydrogenize, the preparation and the trial run, etc. So in terms of our technology roadmap as well as priority in terms of the new technology, where our major foods right now, our focus is on that front, and in terms of is hydrogenize is much bigger priority than going to probably the electrification. If you can just throw some light on.
No, I would say that we prioritize one over the other. Both are in very different segments, and both have different needs in each of these segments. Currently, we see hydrogen ice as an upcoming technology which will be deployed beyond 26 onwards, towards 26 to 2030, and we are preparing ourselves towards that. Electrification is there in pockets in different segments already today, but will not be a dominant one in heavy commercial vehicles. So we have hydrogen ice in those areas, and electrification is a dominant technology for the future in two-wheelers, three-wheelers, and passenger cars, and we are also working and preparing ourselves for that. So these are two different categories, and no need also for us to internally prioritize on any of them. We are working on all of them.
Okay, good. Good to hear that. And so, to achieve all this technology, so one of the participants was earlier mentioning about the capex. So so far the capex is more driven towards localization and the machineries and all. So when we look at these technologies, do we really require to step up the significant jump in the capex going forward? As you also mentioned that we are evaluating how to best put to use to the cash which we have in the balance sheet. So if you can throw some light in terms of the directionally in terms of capex. So is it going to significantly increase because you will have a new technology will keep coming in then?
So what has been showcased is the capex plan for 2024. Of course, for other technologies that we introduce and also get into localization and manufacturing like electrification or hydrogen or other things which come in the future, there will be more capex required. That's clear. And we are looking into that, and as and when we have further updates on that, we'll certainly get back and update you.
Sure. And in terms of lastly, in terms of the overall technology, not only on the powertrain side but also on the vehicle side, like say the new technology or the new smart vehicle system, etc. Like we have the camera based viewing system, etc. So what is the kind of thought in terms of Bosch India? Because we have these technology globally, but I don't think we have a meaningful presence in India for all these technologies. So if you can help us understand, are we looking to bring those technology, because the technology gap gradually is going down, between say the developed market and the developing countries like India. So the technology earlier, the gap between technology was probably a decade. Now it's shrinking to say 2-3 years, and maybe with the smart vehicles and all it will be even lesser than that. So
let me start and I'll let my colleague Sandeep answer after that. See, in terms of technology, we have a global portfolio of these products and technologies which are offered to Indian OEMs. We of course also do Indianization of these technologies as and when required and offer them to the OEMs. What you brought in as examples may not necessarily be in the portfolio of Bosch Limited, and then it doesn't matter whether that's required or not. But in any case, whatever we have as a general rule, whatever we have as technology globally is available for Indian OEMs, and further customization of that or even local development or local variant development for Indian OEMs is always done in India and offered to the OEMs. You want to add anything?
Well, I think you've covered most of it, Guru. So while these portfolio will necessarily not be within the Bosch Limited portfolio, but on a bigger mobility scale, of course there are technologies which is getting adapted, like Guru mentioned. So this could be in the area of drive assist or parking assist or automatic emergency braking or driver monitoring, etc. These are things which are being worked on.
Okay, got it. Thank you.
Thanks, Priyaranjan. Due to time constraint, we'll take the last question from Basudev. Please unmute and ask your question, Basudev. Basudev, we could not hear you. I think he's. Can you go to the next question, sir, or we want to close, sir?
Last question.
No, we can take one last question and close.
Okay. We'll take the last question from Mr. Rajesh. Please unmute and ask your question.
My questions regarding the exports and margins were exhaustively discussed with previous participants. I wanted to clarify that and on EGT two things though from your answers. regarding EGT, from your answer, am I to understand that as and when EGT is localized, it would be part of the listed entity in terms of its sales and margins and not be a traded good?
Yes, you are right.
Oh, that's good. That's okay, because there was some uncertainty about it earlier, so thanks for clarifying that.
So we are currently importing from Bosch Group companies. We are importing and we have it as traded good according to the transfer price agreements based on arm's length, of course. And we are localized. We localize in the listed company, and therefore we have then also the benefit in the listed company of localization. Yes, you are right.
Okay, thank you. And the second question was related to the answer. When we import for traded goods, we have a contract due to transfer price. If it's internally or if it's externally, we have a procurement price. And then, therefore, this gap that we have in our inability to pass on costs, it's not just about, the competitive environment here. It's a two-way agreement, right? We're buying from somebody, we're selling to somebody, we are just a trader. So if at all there is a gap in maintaining our margins, it should be temporary in nature. Is that right? Or have we made a mistake in the contract and somehow we are not able to, that we have agreed for price increases on our buying side, but somehow not penciled that in our selling?
No, if you import today, then of course you buy something, you trade it, and you sell it. Localization is then that we first of all localize the value add part, where we here in India, of course, in the value add competitive, highly competitive, cost competitive, and in addition, as the second step is then, as I explained in one of our meetings before, that we usually start with the assembly, and then we go ahead with the child parts, we start the localization of the supplier, and this is all part of the whole story, that we try to localize as much as possible value add plus material here in India, because on the long run, this is how we maintain our margins.
Thanks, sir. Maybe I didn't explain my question clearly. What I meant was, currently we are having a gap in passing on the cost of traded goods, right? And I'm trying to clarify that it's purely a timing gap, that in the forthcoming quarters, the contracts get automatically adjusted? Or is it that we made a mistake in the contract and somehow some of these cost increases cannot be passed on?
No,
as traded goods.
Yeah. So actually, for the traded goods, for the pricing issue and recovery of certain things, my colleague answered already. What we mean is, if we talk about the change in the product mix, if I look at if all my products are 100%, that we see an increase in the portfolio which is traded. And the only way to balance it is that we go ahead strong in the localization.
So just to answer quickly and close this, we do not have issues with contracts, and we do not have any such things. Costs will be passed on and recoveries will happen, but there are processes behind it. And OEMs also ask for a lot of clarifications, justifications, and so on. And this is work in progress today. And the real cure for this issue is having much higher localization effort than what we have today. And that is the effort we are putting in. Contractual passing on of costs will happen and recoveries will happen as per the contracts. And there is no issue with that.
Thank you so much. That's so clear. Thank you.
Thanks, Rajesh. On behalf of B&K Securities, we thank all participants for joining the call, and thanks to Bosch management for taking time out for the call and giving us the opportunity to host the call. Have a good day.
Thank you very much.
Bye bye.